This is a BC Eagle Finance video. Brigham and Houston Chapter 4 Financial Statement Analysis, a review of Table 4.2 Liquidity and Asset Management Ratios. Your Brigham and Houston text summarizes the ratios from Chapter 4 in its Table 4.2. But what it does do is to refer to the financial statements for the company Allied Food Products that appears in Chapter 3. What this video does is to tie the two together. Specifically, this video will discuss the liquidity and the asset management ratios. Any financial ratio is simply a fraction that is interpreted by taking dollars of whatever caption is in the numerator for $1 of whatever caption is in the denominator. For example, from Principles of Accounting, you know the current ratio is the total current assets divided by the total current liabilities. For the Allied Food Products Company, the total current assets would be found from the current portion of the balance sheet, in this case $1 billion, and divided by the total current liabilities, which is found by viewing the current liability section of the balance sheet and getting the figure current liabilities, $310 million in this case. Dividing $310 million into the $1 billion of current assets gives you a ratio of 3.2 times. Interpret this by saying that you have $3.20 of current assets for every $1 of current liabilities. That means that there are $3.20 of cash generating assets, the current assets, for every $1 of cash demanding liabilities, which would be the current liabilities. The larger the current ratio, the more wherewithal a company has in meeting its current liabilities as they come due. In addition to calculating a single ratio for a company, it's good to compare that ratio to an industry average. In this case, the Allied Food Products, which is a grocer, has a current ratio of 3.2 compared to the industry average of 4.2. So that means that the Allied Food Products Company does not have the financial wherewithal to pay its current liabilities as they come due, as well as the industry that it's in. Now, let's examine the quick ratio. The quick ratio takes the total of the current assets and deducts inventories as its numerator and divides that value by the current liabilities. It's a more stringent measure of the ability of the company to pay cash to liabilities as they come due. Let's look at this numerator. It says take the total of the current assets and deduct inventories. What is left are cash equivalents and accounts receivable. Cash can be used immediately to pay liabilities, and accounts receivable, if the company has terms of net 30, means that it takes about 30 days to quickly turn these assets, accounts receivable, into cash. So the quick ratio essentially measures the ability of the company to generate cash in about 30 or so days. So the total of the cash, $10 million, plus accounts receivable, $375 million, gives $385 million of quick assets divided by $310 million of liabilities that will demand cash, and it gives about a 1.2 times ratio, meaning that there is $1.20 of assets that can quickly turn themselves into cash for every $1 that is demanded in liabilities. Comparing this ratio to the industry average, and again you can see that the allied food products is not as liquid. It can't pay its liabilities as quickly as the industry in which it's in. Now let's take a look at the asset management ratios. Your text reviews for the inventory turnover, the days sales outstanding, the fixed assets turnover, and the total assets turnover. The first two ratios, the inventory turnover and the days sales outstanding, addresses how quickly a company can generate cash from its inventory. The second two ratios indicate how profitable the assets are in generating sales. Let's examine the inventory turnover. It's calculated by sales divided by inventories. So let's look at the balance sheet for a minute. The current assets section of the balance sheet consists of cash and equivalents, accounts receivable, and inventories. So here is the logic. A company, like a grocer, has inventory on its shelves that it sells, and if the sale is made on credit, it has an accounts receivable that the company must wait 30 or 45 days to collect, and then after that period the cash is collected and the company has an asset cash. When a company sells its inventory, it must replace that inventory in order to make more sales. So what the inventory turnover ratio measures is how many times the business must restock its inventory for its level of sales. The higher this inventory turnover, the more rapidly or quicker the company sells its inventory, meaning that it's fresher. So for Allied Food Products, with $3 billion in sales divided by the $615 million of inventory, that means that it restocks or turns over its inventory 4.9 times a year. To look at this a different way, let's take the 4.9 times restocking and divide that into the number of days in a year, 365. So 365 divided by 4.9, that means the company takes about 75 days to sell and restock its inventory. 75 days is about 2.5 months. Comparing Allied Food Products inventory turnover to its industry average, the industry average is 10.9 times a year, almost 11 times a year, and if we would divide 10.9 into 365, that means that the industry turns over its inventory every 33.5 days. That means that the inventory of Allied Food Products is lying around 40 more days than the industry in which it participates. So that means its inventory is a little bit more stale than its competitors. Now let's look at the second part of the sales cycle, and that's collecting the cash after the sale, and that's measured with the days sales outstanding. The numerator of the ratio is the company's accounts receivable. The denominator of the ratio, annual sales divided by 365 days per year, produces the sales per day. So in this case, $375 million of accounts receivable outstanding divided by $8.2 million of sales per day means that there are 46 days of sales tied up in accounts receivable. In other words, it takes about 46 days for Allied Food Products to collect its cash after the sale. If Allied Food Products have collection terms of net due in 30 days, it's about a half a month late in collecting its accounts receivable. And this is borne out by comparing Allied Food Products days sales outstanding to its industry average. The industry average collects its sales in 36 days. It takes 10 days longer for Allied Food Products to do the same. Putting the first two ratios together, the inventory turnover and the days sales outstanding, if we calculated that the days to sell inventory is 75 and it takes 46 days to collect, 75 plus 46 produces 121 days from the time that the inventory is sold until the time that cash is collected. 121 days is about 4 months. That's a very long time to wait to collect cash after making a sale, or a very long time between the time the inventory is stocked in the shelves and the cash is collected. Third, let's examine the fixed assets turnover. The fixed assets turnover is the sales divided by the net fixed assets. The net fixed assets of a company would be its net plant, property, and equipment. The total purchase price of the plant and equipment that the company has that it uses to generate sales, less any depreciation. So for this Allied Food Services company, they have $1 billion in net fixed assets, and these $1 billion of net fixed assets are able to generate $3 billion of sales. So the productivity measure is the company can generate $3 of sales for every $1 that it invests in productive capacity. And comparing that to the industry average, in this case, Allied Food Products does a little bit better than its industry. Another measure of the effectiveness of the assets in generating sales is to examine the total assets, which includes the current assets as well as the plant, property, and equipment. So total sales divided by $2 billion of total assets means every dollar of total assets has the wherewithal to generate $1.50 of sales. Comparing this to the industry generates $1.80 in sales for every dollar of assets. So that means that the Allied Food Products company is carrying more accounts receivable and inventory than its competitors do. That hurts the company's cash flow, and that is the general conclusion that we reach with asset management. It uses its assets well to generate sales, but it's very slow in making the sale, and it is very slow in collecting cash after the sale is made. This concludes the liquidity and asset management ratio analysis. Thank you for listening.